Welcome everyone to another of our weekly investment videos, and many thanks once again for tuning in. This week's video is a little different as it's just myself. For those who do not know me, my name is Andrew Alexander and I'm a director and head of investments of Three Counties Limited, an independent financial advisor based in the northeast of England. This video is going to cover off the impending changes we are planning to make to our advisory investment portfolios, with recommendation letters detailing all of these changes currently in the process of being posted to all of our clients and investors into these portfolios. However, this video is ultimately for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. And remember, past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. Our centralised investment process utilises information and market data supplied by Morningstar, the world-leading financial services firm based in Chicago, USA. Not only do they provide us with the attitude to risk questionnaires that we use with our clients to determine the level of volatility that clients are comfortable with, but they also provide us with asset allocation guidance in order to construct our advisory portfolios. Every year, Morningstar advises us of their recommended changes to each portfolio, using current valuations and the trade-off between both risk and reward, in order that each portfolio outcome remains aligned with investors' long-term goals. Today's video will outline these, both in terms of overall volatility measures reflected through broad traditional asset class allocations. I will then explain any changes recommended within geographical allocations, and finally any changes to underlying funds to reflect our investment committee's view upon investable opportunities over the coming 12 months. Again, please be aware that all of this information will be detailed in personalised letter to all our clients and investors over the coming days. First off, broad asset allocation. Across all portfolios, there is no change to the allocation between risk on and risk off assets. Fundamentally, we are not increasing nor decreasing our equity exposure. The same goes for our low risk fixed income allocation and our alternative exposure. Moving on to geographical equity exposure, there are some slight changes. From the Morningstar recommendation, we are recommending adding US equity, as they have upgraded their view on the asset class's intrinsic value. UK equity has been the main source of funding for this, although it does remain a significant position across all portfolios. We are modestly reducing our exposure to emerging markets in Japan, which were strong performance relative to Europe, and finally added back in Pacific ex-Japan equity as the relative attractiveness has improved, justifying a small exposure to the asset class. Now moving on to the changes to the underlying funds and managers, and let's keep on with the theme of equities. Throughout recent webinars, you will have heard me discuss the reopening of the global economy as the COVID vaccine is rolled out. Following on from 2020's market dominance by technology and new economy stocks, we've seen a rotation of favour into traditional cyclically exposed value stocks, who on a valuation basis look very attractive, historically so, some may say. Combined with rising bond yields, central banks grapple with the process of removing the economic life support for an increasingly strengthening economy. It is our view that now is the time to maximise on these perceived opportunities for our clients and increase cyclical exposure. Furthermore, we believe that the easy money has been made. Since the latter half of last year, most developed market equity indices have rallied strongly, with this rising tide lifting all boats. Now, we believe, is the time to be more selective in our fund allocations, and as such, we have made the decision to fund this increased cyclical exposure by switching out of the passive funds held currently within the portfolio. This naturally will have an increased cost in the underlying fees paid to each fund manager held within the portfolios. Once again, All of this will be detailed precisely in the recommendation letter that each client and investor will receive in the coming days. However, it is our sincerest belief that this additional cost will be outweighed by the excess returns generated by the selected fund managers during this most interesting of times. And this is the same situation when looking at our fixed income allocation. We've been very successful over the past 24 months in positioning our fixed income allocations, making rather bullish calls against the backdrop of what we felt was greater certainty. During Q4 of 2019, in the lead up to the now final days of the Brexit debate, we increased our fixed income duration as we felt that equity market volatility could increase. This served us well, but came into its own during the first quarter of 2020 when the world was plunged into a global pandemic. At this point, our long duration position delivered returns in excess of any historical measure, and as such, we wrote out to all our clients advising that we should take profits and hold cash for the short term as markets attempted to find a footing. During the summer of 2020, we then wrote to all clients advising to rotate this fixed income allocation, currently held in cash, into short duration bonds, essentially the reverse of our previous recommendation, due to what we perceive to be huge pressures on fixed income assets and this is the important factor, as the lower volatility element across all our portfolios. This, once again, was the ideal position to be in, as fixed income assets came under huge pressure as equity markets rallied on the hope of an easing of lockdown restrictions. And this is where we are today, short duration on both government bonds and corporate credit. However, as with equities, there are huge opportunities to the downside and the upside, less so to the upside, to be perfectly honest. That requires specialism. As such, we are recommending a similar, more active approach to fixed income, and are therefore advising that the current short duration position be switched into an active strategic bond approach, so that any potential opportunities can be maximised. And this is also the case with alternatives. The current infrastructure and gold positions will be continued, but again within an actively managed fund, widening the opportunity set in which I firmly believe will become the most important broad asset allocation over the medium term as equities and bonds come under continued pressure. Once again, the overall volatility of each portfolio does not alter. We are not overweighting or underweighting any of the traditional asset classes. We are simply looking at the world as we see it and applying our thoughts and experiences to our portfolios in the same way as we have done for many years. As I have mentioned numerous times in this short video, all clients will be receiving personalised recommendations based upon the portfolio or portfolios that they invested in within the coming days. This will expand on what I've outlined today, detailing the individual funds being replaced and the recommended alternatives, with all costs fully detailed. If at this point you wish to discuss the contents for clarification, please do not hesitate to get in touch with your advisor or myself. I'm always more than happy to discuss any topics, investment or otherwise, with any of our clients, and genuinely my door is always open. I hope that you have found this video to be of interest, and I look forward to speaking to you all soon.